Hello everyone, welcome to BISP Solutions. So today we will be talking about forecasting and financial modeling, what it means, why it is important and how it helps companies plan better. So first of all, we have learned in our previous session about ratio analysis, types of ratios involved in analyzing companies data, and we have taken a company named as Eicher Motors, so that by that data of Eicher Motors we have calculated our ratios. So before moving forward, we will be checking our ratio analysis which we have done in our previous session. So we have calculated our sales growth, EBITDA growth, EBIT growth, net profit growth, dividend growth for growth ratio analysis. Then we have calculated our margin ratio analysis for gross margin, EBITDA margin, EBIT margin, EBT margin and net profit margin we have calculated. Now in our next ratio we have calculated in context with our sales. So we have calculated our sales expenses percentage, depreciation percentage, operating income percentage sales. Then we want to calculate our health of the company, so we have calculated our return on capital employed, retained earnings percentage, return on equity percentage, self-sustained growth rate, interest coverage ratio. Then for understanding working capital turnover ratio analysis, so for that only we have taken our debtor turnover ratio, creditor turnover ratio, inventory turnover ratios, fixed assets turnover and capital turnover ratio. If we want to calculate our days for different heads, so we have calculated days ratio analysis. So for that we have calculated debtor days, payable days, inventory days, cash conversion cycle, and after that we have calculated our CFO upon sales for cash flow ratio analysis. So we have calculated in cash from financing activities. So for that we have calculated from sales, total assets and total debts, and also we have made our trend lines by using the function insert, and in spark lines we will be getting our line option. Then we can create trend for the same. Then we have calculated our mean and median. So for calculating our mean, there is no formula for mean, so we have calculated through our if error function. Then we have averaged out our sales growth from March 16 to March 24, and that is how we can calculate our mean. And for median we have taken the formula of median, and we have selected the data from December 14 to March 24, and we have just calculated in first sales growth, then we have just copy pasted it till the end. So this is what our ratio analysis was about. Now we will be moving forward to our today's session, which was forecasting and real world forecasting examples we will be taking for Eicher Motors. So first of all, what is forecasting? Forecasting is like predicting the future of a business using past data and current trends. Here we can create future estimates of revenue, expenses, profit, cash flows, balance sheets items. So it's like a roadmap for the future based on where we have been and where we want to go. So next is our why is forecasting used. So forecasting helps answering questions like will we be profitable next year, can we afford to launch a new product, and do we need external funding or not. So forecasting gives clarity and control over business decisions. It's not just guessing, it's strategic planning backed by numbers. So why do companies do it? So let's say Eicher Motors, the company behind Royal Enfield, wants to expand into electric motorcycles, set up a new manufacturing plant and enter new global markets. So before doing that, they will need to know how much sales they will make next year, what will be their operating cost, and how much profit or loss they might make, and if they need a bank loan or can use internal funds. So that's where forecasting helps. It allows management to make well-informed business decisions. After that, how is forecasting done? So step 1 was to analyze past performance, where we will be looking at previous year's data, revenue growth, margins, expenses. Then we will be setting assumptions like estimating future sales growth, inflation, input costs, etc. For example, assuming sales will grow by 15% next year. Then step 3 will be our building forecast model, where we will be using formula in Excel projecting revenue, EBITDA, net profit and cash flows. And step 4 will be our review and adjust, where we will be checking if the forecasting is realistic, tweak assumptions if needed. Next is our how it helps companies like Eicher Motors. So Eicher Motors have shown mixed growth over the years, so some ups and some downs are there. So forecasting helps them plan production capacity based on future demands, set realistic sales and marketing targets, and control costs by anticipating future expenses and predicting fund needs well in advance. So for example, let's take an example for the same. If they forecast 15,000 crore in sales next year and no margins are 20%, so they expect 3,000 crore rupees in profit. So that helps them to decide whether to invest 1,000 crore in a new plant or not. So benefits of forecasting is to it avoids surprises, supports budgeting, helps in investor presentations, guides fundraising decisions, and builds in management confidence. So in simple words, it helps companies see the future before it happens. It reduces risk and improves decision making also. So is it always accurate? So forecasting isn't 100% accurate. It depends on assumptions we make. So but it's better to have an educated estimate than go blindly. So that's why companies update forecasts regularly, quarterly or yearly as new data comes in. Next is why should we care? So if we are an investor, employee, manager or student, understanding forecasting helps us for reading reports better, predicting company performance and making better decision in business or finance. So remember, forecasting in financial modeling is not about being perfect, it's about being prepared. Next is our practicing for the same. So what we will be doing, we will be going to our forecasting sheet. Then what we will be doing over here, I have given a formatting over here where I have linked my Eicher Motors Limited for sales forecasting from my data sheet, and next we will be calculating our EBITDA forecasting we will be doing, and earning per share forecasting we will be doing. So now what we will be doing, we will be writing over here 1, and now if I don't want any manual entry to be done, I will be adding 1 over here. Now what I will be doing, I will be dragging it till 17th. Now my years, so for years what we will be doing, we will be going to our ratio analysis or historical financial statements where we have already mentioned our years. So what we will be doing, we will be seeing from which year they have started. So December 14 they have started. So for that what we will be doing, 2014 we will be doing, and then if there is any, okay, so 16, 17, 18, so 15 is not there, so we will be doing manual entry over here. Then from 2016 this plus 1. Now we will be dragging it till the end. So it is our 2031. Now if I see my sales, so for that what I will be doing, I have sales for 2024. I will be selecting the cells, and what I will be doing, I will be pressing F2, then it will be getting enabled. Then I will be doing a formula over here, transpose, and it is asking me array. So for that we will be going to our data sheet. Then I will be selecting from this sales till the end. Now I will not be entering or clicking the enter button. What I will be doing, I will be pressing Ctrl Shift and enter, then it will be giving me the data over here. Now firstly we will be checking it that it is having number over here or not. Then if we want to calculate our sales growth over here, so what we will be doing, we will be dividing our 2016 data from our 2014 minus 1. And percentage. So it is showing us errors over here. So before doing that, let's do one more setting over here. We have selected 2024 till 2024. We have selected this data, and Control plus 1 we have selected. I have already mentioned in my previous sessions also to do a small change. So if we are having 0, and what we will be doing, we will be writing A over here, so that we will get a knowledge about this is the actual data and this is the forecasted data. So for the same thing we will be doing again custom and F for forecasting and OK. So this is our forecasting data and this is our actual data. So this has wrongly been transposed over here. So just a second, we will be again selecting the data till 2024, Control plus 1, then custom 0 and A and OK. So after that this selection and custom, then F and OK. So this is done. Now we have to move it in left side and this is to the right hand side, and sales what we have to do till A. So it is asking OK till A. What we will be doing, F2 equals to transpose, then it is saying array. So we will be adding this till March 24 and brackets are closed, then Control Shift and enter. Now our sales is copied correctly. What happened before that, when we have selected from this December 14 to March 24, it has only selected March 24, that's why it is showing 0.00%. So we have again calculated it, so it is giving us this data. Now if I want to calculate my sales growth, so I will be dividing my 2016's data from 2014's minus 1, and it will be showing me the answer which I want. Now I will be doing it a little bit for formatting for percentage. So Alt H and P, again Alt H and 0, Alt H and 0. Why I use this shortcut because I want 2 decimals for my percentage. So this is my completed actual data's calculation for forecasting. Now if I want to forecast, what I will be doing, I will be selecting my data or formula as forecasting. Then what I will be doing, I will be selecting my 14th, I will be selecting my 11th year's data, or we can say year weight. Then I will be selecting my sales and will be pressing F4. Then I will be selecting my year weight, which is from 1st to 10th, and then I will be entering the same. Then Control plus C and dragging it till the end. So it is showing me the same answer for the same. What I will be doing again, equals to forecasting, then 12, and known wise is our sales. It is again showing us the same issue. Then our year weight. Now if I move to my sales, I will be pressing F4 and F4 also over here, and F4. Right, now done. So it is showing me error, what we have done wrong over here. No, just a second, we have to do over here also. Before selecting this, we will be doing F4 to both, and done. Control plus C and dragging it till the end. So now it will be showing us forecasted data. So for the same, what we will be doing, I will be highlighting the forecasting or the calculated one, and same formula will be dragged till the end. So we have to calculate only once, then we can calculate it for other datas also. So over here I am also taking this, and the same thing I will be taking over here, and year weight will be on left side, years will be on right side, and over here I will be changing it to EBITDA, and over here EBITDA growth I will be mentioning. Now if I want to take EBITDA, so what I will be doing, again I will be selecting the data from 2014 to 2024, and again F2 will be pressed, F2 will be pressed for transposing, and then we will be going to our historical financial statements. Then we will be selecting from December 14 till 24th March, 2024 year, and then brackets close, then Control Shift and Enter. Now our EBITDAs are transferred over here. Again what we will be doing, Control plus C and paste the same. So what they have taken, correct data or correct formula they have taken, till the end we will be doing that. Then equals to forecast, or we can do one thing for doing our things more easily. So we will just drag it, it is again so we will be copying it and pasting it over here. It is taking this side's data and we will be moving over here like this, Control plus C and dragging it till the end. we will be decreasing the decimals, and again the same thing will be done. Now my EBITDA is also calculated. Now I want my earning per share forecasting, so I have selected this data, pasted over here, 2014 data, years, and again EPS is there. Then EPS growth we want to calculate. Now earning per share, so we will be taking that EPS from our historical, so again equals to again we will be selecting till 2024, then we will be pressing F2 for enabling our transpose. Then we will be going to our historical functions, financial statements, then we will be selecting earning per share, which is down right from this side from till March 24, then closing the bracket, control shift and enter. So our data is linked with the same. Now again what we will be doing, the same thing we will be doing over here also. It is taking that data of, and we will be, just a second, now continue doing the same thing, and what we have to do, control plus C and control plus V. So for checking, it has taken the right data, right. Now control and drag it till the end. So till the end we got our forecasting for sales, EBITDA and earning per share. This is how we can do our forecasting for our Eicher Motors data. Now moving forward, we will now understand present value, which comes under time value of money. So before moving forward to present value, time value of money is like a rupee today is worth more than a rupee in the future. So it's the current value of a future amount of money. It answers how much should I invest today to get X rupees in future. So the formula is PV, which is present value, is equals to FV, is future value, divided by 1 plus R to the power n. So where our FV is our future value, R is our interest rate, and n is our number of periods. Next comes our future value, which is the amount we will get in the future from money invested today. So the formula says FV is equals to PV into 1 plus R to the power n. Then comes our annuity, where a series of equal payments at regular intervals will be there. For example, EMIs we pay for some personal loan or auto loan like that, and rent we pay for a home or shop. Then two types of annuity are order annuity, where payments at the end of the period is done, and annuity due, where payments at the beginning of the period is done. So we want to calculate present value of annuity. So for that, PVA is equals to PMT into 1 minus 1 upon 1 plus R to the power n divided by R. So PMT is regular payment, and future value of annuity, where FVA is equals to PMT into 1 plus R to the power n minus 1 upon R. Then perpetuity, where a stream of equal payments forever, for example fixed dividends, is there. Formula for the same is PV is equals to PMT upon R. So why TVM is important? TVM is our time value of money because it is used in investment decisions, loan calculation, retirement planning, and business valuation. And it is core to techniques like DCF modeling, NPV, IRR, and bond pricing. So let's start a case study where we will be relating to time value of money. So our case study is about imagining like I am a parent and my daughter is 10 years old today. So I want to save money for her college education, which will cost around 10 lakhs rupees when she turns 18. So we have two options. First is our present value, where we will be asking how much should I invest today in a bank FD earning 8% annual interest rate to get 10 lakhs after 8 years. So we will be using formula which is PV is equals to FV into 1 divided by 1 plus R to the power n. So for calculating it, I have taken the data and I have calculated it with this formula only. So we have to invest around 5.4 lakh today to get 10 lakhs in next 8 years. Next is our future value, where we decide to invest 1 lakh rupees today. So how much will it become in 8 years at 8% interest rate? So we will be using formula FV is equals to PV 1 plus R to the power n. So approx we will be getting 1,85,000. So for that we will be investing 1 lakh rupees, which will be growing 1.85 lakh rupees in 8 years. Next method is our annuity method, which is called as monthly saving plan, where we can't invest 5.4 lakh at once. So we decide to save every month. So now we will be asking, if I invest 10,000 every month for 8 years, how much will I have? So for that we will be using our formula which says R, which is 8% annually. So if we want to calculate monthly, so we will be dividing it by 12, which will be coming as 0.667% per month, and number of years, which is 8 years. Now we have to convert in months, so we will be getting 96 months, and future value will be approx 12.3 lakh rupees. So we will have more than enough if we start monthly savings of 10,000 rupees. Next is our present value of annuity, where instead of these all which we have studied till now, we got an offer plan that will pay 1 lakh rupees per year for 4 years for college of our daughter, starting in year 9 only. So we will be asking, what is this future scholarship worth today? So this is the present value of an annuity for this thing. So for that we will be using PVA is equals to PMT into 1 minus 1 into 1 plus R to the power n divided by R. So this gives the current value of those future payments, so we can compare it with another investments. Next is our perpetuity, where we will be investing in a scheme that pays us 50,000 rupees every year forever. For that we will be using PV is equals to PMT into R, and 50,000 rupees we will be investing forever. To get 50,000 annually forever at 5%, we must invest 10 lakh rupees. So it means for present value, how much we will be investing today to meet a future goal. FV, which is future value, where how much our savings will grow over the time. Annuity, where monthly SIPs or EMIs will be done. PVA, where value today of scholarship or pension we will be calculating, and perpetuity where retirement plans paying lifelong income. So now we will be moving ahead to our next topic, which is DCF modeling. Before starting the topic, let's take a very easy and simple example of a tea stall. Before that, so we will be understanding it by a calculation. So first step will be estimating future cash flows, where our goal is to buy a tea stall and we want to know how much it's really worth today based on the money it will earn in the future. So the owner Ravi says the tea stall earns a profit of ₹1 lakh each year and he expects it to stay steady for the next 5 years. So the future cash flows will look like this: first year ₹1 lakh, second year ₹1 lakh, and so on with the till the end. Now these are the expected cash flows. Now second step is choosing a discount rate, where we will be thinking that keeping money in a safe bank FD gives 6% of return, so we want at least that much from this deal. So our discount rate is 6%. Now our step third is calculating the present value of each year's ₹1 lakh using this formula: PV is equals to future cash flows into 1 plus R to the power n. So we will be calculating by taking the same table from our step 1 and copying the same thing, pasting the same thing, and I have calculated it by using some function. Then I have taken rate of interest as 6%, which is mentioned over here, and when I want to do totaling of the same, so it will be showing me the discounted cash flow. Like in first year, if Ravi is calculating ₹1 lakh for 5 years, like it will be steady for next 5 years, ₹1 lakh he will be earning. So if we calculate it with this particular formula, it will be like 94,340 if we do an approximation over here, then 89,000 from second year, third year it will be 83,962, then fourth year it will be 79,209.37, and in fifth year it will be 74,726 rupees. So if we calculate the same thing, it will be less than 5 lakh rupees. So our future value will be 4,21,236.38. So step 4, Ravi and I will be deciding that the shop will be 4,21,000 rupees, and it will be the worth for me today based on the future profit it will generate. So we will be understanding if Rafi is asking 3.5 lakh rupees for selling his shop, so it is a good deal, we will be buying it. But if Ravi is asking for 6 lakhs, it is too expensive based on our DCF model which we have done in this particular table. So how it relates to, this is our steps which we have already discussed. So why it is used? So to value a company or investment based on its ability to generate cash in the future, to support investment decision, for example mergers, acquisition, equity research, and to determine whether a stock or project is undervalued or overvalued, to assist in strategic planning or fundraising also. So what does DCF show? It shows the intrinsic value of a company or asset, whether the future cash flows justify the current market price or not, the expected return on an investment. So how DCF help companies? in valuation of M&A, where we will be using for M&A, which is mergers, acquisition, or selling a business. Then project evaluation, where whether a new project will be profitable or not. And then fundraising, where investors want to know the value of the company. And strategic planning, where we will be choosing the best projects based on value creation. And lastly, budgeting decisions, where forecast cash needs or growth will be done. So benefits of DCF modeling: first is it focuses on actual cash, not accounting profits, based on future performance, not just past data is there. Various scenarios, it means flexible, can text various scenarios, best case, worst case, and base case will be there. Then provides a detailed view of value drivers like revenue, margins, and growth. So steps in DCF modeling: first is projecting free cash flows, where we will be estimating how much cash the company will generate in the future, usually for 5 to 10 years. Next is our calculating terminal value, where after the forecast period, estimating a lump sum value for the remaining life of the company, where the two common methods are there, like Gordon growth method and exit multiple method. Next is our discount cash flow to present value, where future cash flow is not as valuable as today's cash due to inflation or risk, so we will discount all future cash flows to today's value using a rate called WACC, which is weighted average cost of capital. Next is all present values will be added, which means adding discounted cash flows from year 1 to year 5 or 10 we can take, plus terminal value we will be taking. This will give us the enterprise value of the company. Lastly, we will be adjusting for debt and cash, which means the final step we will be taking as equity value we want, so we will be deducting from our enterprise value net debt. So for an example, if we say we are expecting a company to earn 10 lakh rupees every year for 5 years, but 10 lakh rupees from 5 years from now is not the same as 10 lakhs today. So we will be calculating our present value of each year's 10 lakh using a discount rate, say about 10% is there, and then we will be adding up to find today's value of future earnings, that is the value of the company. So we will be again going to the same, and if I have changed this to 10 lakhs, okay, and same till the end, so it is giving me 50 lakh and the rate of interest is 10%, let's say. So this is what our future or 50 lakh will be after 5 years. It will be like 42,12,363.79. So why DCF is important? Used in investment banking, equity research, private equity, corporate finance. It helps in M&A, valuation, buy and sell decisions. So forecasting is a cornerstone of financial modeling, providing businesses with a powerful tool to plan for the future and make smarter decisions. By leveraging historical data, current trends, and logical assumptions, companies can predict their financial performance, prepare for uncertainties, and seize growth opportunities. Whether it's guiding resource allocation, supporting strategic decisions, or ensuring financial stability, forecasting serves as a beacon for businesses navigating the complexities of today's dynamic markets. So to conclude, we have walked through the fundamentals of discounted cash flow modeling, understood its real world application through a structured case study, and applied that knowledge to a live company, Eicher Motors Limited. We have seen how projecting future cash flows, discounting them using WACC, and computing terminal value can help estimating a company's intrinsic worth. While DCF is a powerful valuation method, it's also highly sensitive to assumptions. That's why it is important to approach it with clarity, conservative projections, and always pair it with other valuation techniques. So, thank you all for your active participation. I hope this session has helped demystified DCF modeling and inspired you to explore financial analysis more deeply. So keep practicing, keep analyzing, and remember, every number tells a story. Wishing you best in your learning journey and career journey.